Hi, this is Zach here with the Major Markets Review. It is Sunday, the 23rd of January. I used to do the major markets every day. I did that every day for 12 years. But now I only do it when people are panicking, which is obviously maybe once every couple of months, something like that. And the last time I was looking at the FTSE, we had these dips to the 200-day moving average that was rising. So I suggested that normally a dip to a rising 200-day line is a buying opportunity, as we had in September. And obviously then we had that after the Omicron spoof at the end of November. And we had another chance, I suppose, with a dip near to the 200-day line back in the middle of last month. Since then, we've had bearish divergence with the slightly higher high for the FTSE towards 7,600, which is quite an achievement, really, given its sort of post-pandemic highs. The other point to note now is that we are still pretty high in the range, just coming back towards the initial January peak, so around the 75, 20, 30 area, so not really far off that. The minimum on the downside, I suppose, what that you would expect now would be, let's say, a test of the 50-day moving average. We had that kind of thing in March last year, so you just have a minor retracement from a new high down to the 50-day line, then up again. Worst case scenario, I suppose, if Putin and Ukraine turns into a complete disaster, is a move down to the floor of that rising trend channel from the beginning of last year. So that would be 71 to 7,200. And obviously meeting the 200-day moving average at 71.50. But at this stage, probably I go for the more optimistic 73.50 to 7400 zone as the worst. And in fact, it may be that we've already seen the worst, but let's just say allowing for 73.50, something like that on the FTSE 100. On to the DAX, which is rather nearer to Ukraine than we are, and so worth looking to see where that is in its range. Here we've had a pullback below the 200-day moving average, and there's an uptrend line there from January last year around 15,350. So that would be the logical area to look for any support dips. We've had those sorts of support dips in October, November, and in December, and so it would be logical to assume somewhere near towards 15,000 anyway as the floor of this market, given that we're already well off the top here. The other way of doing this would be to wait for a break of that resistance line from January. That's currently around 15,700, so an end of day close above that as a momentum trigger. RSI below 50 now, so it's at 42, so that does suggest that we could roll over towards the low 15,000s. That would kind of make sense, even if we temporarily break that line of support from this time last year. Onto the US markets, where people are squeaking rather more than they are in Europe so far. Can't believe, obviously, that the market's down. In fact, what we've seen so far for January is just the same as we had in November, really, going into the Omicron debacle. So logically, this could be near to the end of the sell-off, and obviously people squeal the most at the end of sell-offs. RSI now below 30, which is basically what we had in the end of November. That was a buy point. We also had a similar low for the RSI back at the end of September. That was also a buy point, as was an RSI at or just below 30 back in June. So history repeats itself. We should bounce near to 34,000. Worst case scenario, I suppose, at the moment is that we head one step lower and hit that July support line there at 33,000. But at the moment, I probably would have to favor a bounce near to 34,000 rather than 33,000, given that we've already sold off quite a lot. Going on to the S&P, which some people regard as a more serious measure of US stocks. Here we've got a situation where the market has come back down to the 200-day moving average, and in fact closed below it on a weekly close basis, which might get some alarm bells ringing. Below the 200-day line, around 44.40, let's say, there's the risk of a move down towards the floor of that July triangle as low as 41.70. But once again, the RSI now well below the 30 level, so that does sit in with the fact it's actually lower than it was September, October, and also even with the Omicron scare back at the end of November. So this is a pretty oversold market. Just trying to find when this market was as oversold, and I suppose you've got to go back to the lows, well, the pandemic time, when that's actually when the RSI went sub 20. So basically, odds on at the moment that we will find support pretty near to where we are at the moment, unless obviously there's a complete calamity in the Ukraine. Moving along to a market which I think a lot of people are interested in at the moment, gold. And here we can see that we will be able to see, when I can get the chart up, that it's been sort of teetering around, trying to make a decent impression for the bulls. Here you can see that we've had various sort of higher highs and lows over the post-December period after that final bear trap towards 1750. What we'd like to see, though, for a proper break to the upside is a break of that resistance line there from June through 1860, 1865. If we can get that, then the upside for this market would be the top of that rising August trend channel, currently pointing as high as 1940. So a lot to play for here on gold. I suppose dips towards 1800 or 1810, where the 50 and 200-day moving averages would be the place to go. And then obviously waiting for a clearance of that June resistance line. Going on to crude oil, which continues to be quite a winner, in probably counterintuitive at the moment that it's such a winner, but one shouldn't complain about these things, I suppose. Here we've got the much higher second low for December that this market delivered above $65. Recent gap to the upside as well, sort of partially filled, I suppose, so far. Got a line of resistance there from March last year heading towards 93.50, that sort of area. And that's the target, especially while we hold above recent support, just above $80. So ideally we hold the $80 area and then head higher. If we're really lucky, there'll be no end of day close back or no break back below the floor of that latest gap at $84 ahead of 93 to 94. But maybe that's wishful thinking. The other positive at the moment is the way that both the 50 and 200-day moving averages are both rising in parallel. That tends to give you a decent sort of 4 to 6 weeks of upside, even if then things cool off in the same way that we saw in September. That's when the 50 and 200-day moving averages were rising in parallel, and we had about a month to 6 weeks of rising prices until things tipped over. So that's crude oil. Finishing off with perhaps the one which has the market which has the most degree of difficulty at the moment, Bitcoin versus the US dollar. Again, a lot of squealing around at the moment. What's interesting here, I suppose, a couple of points to note is that after all the declines from near to $70,000 area, we've basically halved. So that's normally a sign of that it's time to focus minds. 50% retracement is a thing for the markets. The other point to note here is that this market is now into the oversold area, so the RSI around the low 20s, in fact, so very oversold. That's the most oversold that we've had since basically May, when we rallied from 30,000 back up to the new highs. And going further back, if I can, you'll see that the last time this market was really oversold, and maybe if we go any lower towards the 30,000 area, then it would match what we had back in the spring of or March 2020, when this market was obviously in the grips of the initial pandemic shock. I was previously looking for this market to hit 30,000, but there is actually a line of support there from the beginning of last year. That could be the major neckline for this market and mean that we don't actually trade much below 34,000, basically the latest lows, and that might explain why so far we haven't just gone straight down from 40,000 to 30,000, which is what you would have expected from the chart pattern that we have, the big head and shoulders from August. So basically holding 35,000 would be or 34,000 would be a major plus. Otherwise, maybe any intraday forays towards 30,000 currently on the Bitcoin price action would be potential dips to buy into. Clearly, a sub 30,000 rather would be quite a bad look, and then obviously that gives us the risk that it is at least over for the time being for bulls of Bitcoin, or long-term bulls looking for 100,000, etc., etc. If you want to play it more easily, then more easy, then maybe wait for a break of the November resistance line projection, that's currently around 38,000, so an end of day close or a weekly close above that would mean that you're trying to avoid getting caught out by trying to catch a falling knife. But as I said, this market now as oversold as it was ahead of a major rally from this spring, late spring last year. So probably the balance of probability now in favor of the bulls. That's it for me today. More updates as they arise.